Ever wondered why you lose so many trades? Good news, this struggle is easy to fix. My name is Dion, full-time trader with over $1 million in funding. And in this video, I'm going to break down the most high probability ICT entry model, the unicorn setup. To do this, I will share the 4 puzzle pieces that create this high probability setup. No time to waste, let's get into the video. When you want to determine where to find the ICT unicorn model, you need to look at 4 puzzle pieces. 4 puzzle pieces that will rule them all. And let's go over the first one. And the first one is one of the most powerful concepts in trading, and that is called the breaker. And if you want to understand what a breaker is, you need to understand 3 key concepts. You need to understand what order blocks are, you need to understand what liquidity is, and where you can find it, and how market structure works. If you're not sure about one of these 3 concepts, I have dedicated videos on this YouTube channel, and I will leave the link to that in the description. So when we look at order blocks, we need to know what order blocks are, because breakers are order blocks, but then the different side, the other side of the curve. And how you can determine an order block is the last down close candles that swept the low before a market structure shift, come back to the order block, and then go higher. And with a breaker, what happens is price ignores the order block, and we can use it as a bearish breaker to the other side of the curve. So we are going to use it as resistance instead of support. More on that in a second. Then you need to know what liquidity is, because a breaker is a breaker structure. So there needs to be some liquidity being taken before the move. This is a key part of a breaker. And also you need to understand what market structure is. When is there a market structure shift? When the last swing high that made that low, that took liquidity, is taken. When that liquidity point is taken, right here, you have a market structure shift. So order blocks, liquidity, and market structure. And what is then a breaker? A breaker, in this bullish example, is the up close candle, last up close candle before that liquidity sweep. So you can identify it by a swing low, a swing high, then that swing low is broken, right here, creating a lower low. And after that, this swing high is broken, creating a higher high. So low, high, lower low, higher high. And the up close candles in this bullish example will give the breaker. So if you look at it in candle format, we have your low, you have your high, you have your lower low, and you have your higher high. And then these up close candles are the breaker. And it's up to trader discretion if you want to do the top candle or you want the whole range. Preferably, I'd like to take the whole range. So from this swing low to this swing high and mark out the breaker. You can also only do this candle. Again, up to trader discretion. Same for bearish example. It's the down close candle, last down close candles before liquidity sweep. So swing high, low, higher high, lower low. And again, there needs to be a breaker structure. There needs to be liquidity taken before this move to be a valid breaker. If there's no liquidity being taken, it's not a valid breaker. So here you have a high, you have a low, a higher high, and have a lower low. The down close candles here, again, you can take from candle to candle, take the whole range, or just this candle. I prefer to take the whole range, but again, it's up to trader discretion. And as I look at an example on the charts, we are looking at NASDAQ at the 1-minute chart. And we are now at the New York Open. Look at the time, it's 9:30. And we have this down move with some further swings here that could be nice to target later. And what you see here is a breaker formation. I see a low being formed. I see a high. This should be a bearish order block, but because we're gonna break it, spoiler alert, we're gonna use it as a bullish breaker. So a bearish order block becomes a bullish breaker. Low, high, lower low. And let's see, once we take this high, then we're gonna talk about a breaker formation, and we do. So right here, from the low to the high, I like to just take the up close candles here. So I would mark out the breaker like this. And what do we see here? So we have a low, a high. The low is taken, liquidity sweep, taking a low, and now we also have created a high right there. And then you can just take your entry from the breaker, stop loss below the breaker. I'll just target the clean 1 to 2. Don't make it more complicated. And this 1 to 2 is also overlapping with these further swings up here. And let's see what the price does. So it gives a nice push, and it comes back into the breaker before eventually going to the TP point. This is only using a bearish breaker. And as you know, there are more puzzle pieces to this unicorn model. So let's now talk about puzzle piece number 2. I spent hundreds of hours studying ICT concepts, and I broke down every single concept with my own personal notes in this 500-page PDF. It goes over everything from entry models to the different concepts, from interest rates to everything you need. So if you want to save those hundreds of hours, wanted to get it right now, I will leave the link to this PDF in the description. So now you know how a breaker works. The second puzzle piece is one of the most important things you need to add to the unicorn model, because a breaker is only one side of the equation. The other side is the fair value gap. And the fair value gap is one of the most easy concepts in ICT concepts. It's a 3-candle pattern where there is a gap between the high of the first candle and the low of the third candle. And the goal of the unicorn setup is to combine these two. So you know how a breaker works, you know how a fair value gap works. When they overlap, there is where you get the unicorn model. So in this example, you have the low, you have the high, you have the lower low, and you have the higher high. When price comes back into the range with an overlapping fair value gap and a breaker, there is where we have the unicorn setup. So not only look for breakers, also look for fair value gap. So if you have a fair value gap or fair value gaps multiple overlapping with a breaker, that is where you need to pay attention. And there is where your highest probability entries will occur. And now let's see this one in action. So you now already know how a breaker works. So we have a high, a low, a higher high, and a lower low. And now we have the breaker marked out. We also now have a fair value gap. So now you have an overlapping part between a fair value gap and a breaker, and now we have the unicorn. So we can just take an entry at the start of the breaker and fair value gap, the unicorn, stop above the high or stop above the breaker. I prefer this one. I prefer above the breaker, but if you want to be safe, go here 412, and then let's see what price gives us. And as you see, price does not tap us in and goes to the TP point. And it's to show you like nothing 100%. With every model, you will still be left behind sometime. Now, if you look at this example on USD, JPY on a 50-minute time frame, what do we see? We have a low, a high, a lower low, and a higher high. We also have a overlapping fair value gap. So what is this? This is a unicorn setup. Let's mark out the breaker. From this point, I will take my entry. I will do my entry at the start of the breaker, stop loss below the low, before I static 1 to 2, and let's see what the market gives us. So it taps in, and you see how the wicks are inside the unicorn, but the bodies are closing above it, making it very bullish. And then price comes to the TP area. So all based on a simple unicorn format. So now you know the basis of the unicorn model. It's the breaker overlapping with the fair value gap. But there are two more puzzle pieces where you can make this unicorn model even more high probability. And this third element is one of the most important thing in ICT concept, and it is time, and specifically the kill zones. And there's a difference between Forex and indices kill zone. So if you trade Forex, watch the top of this chart. And if you are trading indices, please watch the bottom. So we have Asian session, Forex from 8 till midnight, London from 2 to 5, New York AM from 7 to 10, and London close from 10 to 12. If you trade Forex, try to frame your entries inside the kill zones. If you do indices, Asia is the same, London is the same, but the New York AM session is a little different from 8:30 to 11. And then you have a PM session for the indices, for the US indices. And there's also a silver bullet window. There's where your most high probability trades will occur. That's between 3 and 4 for London, and between 10 and 11 for New York AM, and 2, 3 p.m. for New York PM session. And bonus points here, and when you have currencies and pairs that are from the region of the kill zone. So for example, the Asian pairs are AUD, JPY, NZD. Why? Because their region is in the Asian time zone. They're living in Asia. Just like countries from Europe, let's say Euro, GBP, CHF are all European pairs. They move in London, just like the USD and the CAD move in New York session because they're from the region. So if you, for example, have Euro and USD, you know they're probably moving in London and New York, not in Asia, because the regions are not there. So try to think about the region and match them to the specific kill zone. And the fourth and final element of the high probability unicorn setup, we now have a breaker overlapping with a fair value gap that makes a unicorn. If you combine a unicorn with the kill zone, with execution in the kill zone, it's even more high probability. And the fourth and final puzzle piece of the unicorn model is a draw on liquidity. Your unicorn model needs to match with where the price likely wants to go. And a draw on liquidity, there's a dedicated video on this, on liquidity, on this YouTube channel. But to give you a little heads up, price only goes to two things. It is internal range liquidity, that's basically imbalances, fair value gaps, volume imbalances. And we can use that as a place to trade from. So if we have a fair value gap, we can use it to trade higher. And price can also trade to external range liquidity, old highs and lows. So it goes from internal to external, from an imbalance to an old high or low, or going from a high back to an imbalance. There's only two things. At intraday, use a 1 hour array, let's say a 1 hour fair value gap, combine it with a 1 and 5 minute entry. Use 4 hour arrays, 4 hour fair value gaps to a 50-minute entry, and daily and weekly arrays for a 1 hour entry. And bonus points here. If you want to find your highest probability draw on liquidity, follow the displacement, follow the order flow. So that means when price is bullish on the higher time frame, frame longs, frame your bullish unicorn setups. And in a trending move, the opposing arrays should fail. And what I mean by that is if we go higher, we have on the sell side of the curve, we have bearish fair value gaps. We have bearish order blocks, bearish breakers. When we are trending to the upside, these should all fail. And that is where it's confirmed that you're gonna from bearish to bullish or vice versa. So the opposing arrays should fail. And if we go back to our previous example on USDJPY, when we have a clean unicorn, look at where the unicorn is formed, where the low is taken at 3. This is during the London session. So the London silver bullish from 3 to 4 is where your trade idea is probably going to be set up. And the execution is here at 4:45. And let's see if there's a clear draw on liquidity. Well, if we look at the daily time frame, this structure is formed inside a daily bullish fair value gap and also in a daily bullish order block. So in the higher time frame, this was already a very nice move from internal potentially to external. So if we know that, then we can safely sell on the lower time frame, and now we're doing this on the 50-minute inside this area. So now the green line is that order block and the fair value gap. In that area, there is where the structure in this unicorn is formed, making it more high probability. And when can we trade towards? We can take out all these failure swings, and that's what we also eventually do. And you see when this unicorn setup is traded, how it gives a very clean move to take out all these failure swings. And now you have it. 4 puzzle pieces to get a high probability ICT unicorn model. You now know what a breaker is. You now know what a fair value gap is. And the overlapping part is the unicorn model. If you combine that with time, with the kill zones, and you're finding your higher time frame drawn liquidity, you have a very high probability entry model on your hands, which you can use to get funded, get payouts, and get profitable. Next to the unicorn setup, you might wonder how order blocks work, or fair value gaps, or liquidity, or market structure. Good news, I got videos on all of them here on this channel. So I will leave the link to that video somewhere here, up, down, so you can continue your journey learning all the ICT concepts and start making money. Thanks for watching, and I'll see you in the next one.